This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our Dividend Stock Advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
Hold me accountable for the debacle.
Okay.
I'm responsible.
Apology and advocacy. The Health and Human Services chief accepts blame for the botched rollout of the Obamacare website as the president argues the law is really a good thing. But what does the Affordable Care Act mean if you're covered under an employer plan?
Pops and drops, stocks, bonds, gold, and the dollar all on the move after the Fed said it'll keep the stimulus in place. But is it what the central bank didn't say that really drove the market?
Facebook Fever, the social network, reports strong profits and the stock jumps. What investors need to know about Facebook's financials. All that and more tonight on Nightly Business Report for Wednesday, October 30th.
Good evening, everyone. We begin tonight with President Obama on the defensive. Speaking from Boston, the president tried to drum up support for his troubled health care program. He chose to stand in Faneuil Hall, where Massachusetts' health care plan was signed into law 7 years ago and is considered a successful template for the president's own Affordable Care Act. He admitted to problems with his health care website and that people are getting cancellation notices. But he said giving people health care should be a no-brainer, shifting blame for canceled policies on private insurance companies.
Nobody's losing their right to health care coverage. And no insurance company will ever be able to deny you coverage or drop you as a customer altogether. Those days are over. And that's the truth. That is the truth.
Well, despite the rocky start to the health care marketplace, President Obama assured the crowd, quote, "We are going to see this through."
Well, seeing it through is what the president had in mind today, but it was very different on Capitol Hill. Grilled and drilled. That's what happened up there today as members of the House Energy and Commerce Committee grilled Health and Human Services Secretary Kathleen Sebelius over the bedeviled rollout of the healthcare.gov website. The drilling was over administration claims that insured people would get to keep their present plans, basically no matter what. Trouble is, many carriers are canceling low-cost, low-coverage plans because they don't comply with new, tougher insurance standards under the law. Bertha Coombs has more on today's contentious hearing.
Health Secretary Kathleen Sebelius seemed prepared for tough questioning, starting off with an apology to Americans for the rocky rollout of healthcare.gov, the problem-plagued federal site, which was down again today.
You deserve better. I apologize. I'm accountable to you for fixing these problems. And I'm committed to earning your confidence back.
Republican members pressed Sebelius about health officials' late changes to the system design and the lack of proper testing, which last week contractors told the committee contributed to the site's malfunctioning.
No one indicated that this could possibly go this wrong. I was always advised that there is always a risk with a new product and a new site, but never suggested that we delay the launch of October 1st, nor did our contracting partners ever suggest that to us.
A number of members held up letters from constituents whose plans had been canceled in the individual market. Sebelius insisted the administration did not mislead Americans when the president said that they could keep their plans.
Plans change so
every
dramatically
year
over time that the
But-
estimate was they wouldn't be, not because of our rules, but because of insurance companies' business decisions.
Well, but you set up what
market a new
those
plan.
market rules looked like they had to comply with, correct?
Only if they chose not to grandfather the policy. That's the
But
start.
that meant they couldn't
Any
make
grandfathered
change.
policy stayed in place still would be in place.
Right, but if
None
they
of these
made-
rules apply.
But if they made any change,
No, they could make changes in pricing. They could make changes in benefits.
And after saying for weeks that the health department was not going to release enrollment data prematurely, today the secretary explained why.
That data out there exists, and
Sir,
you
I
will
would
not let us
tell you
have
right
it
now, it is not reliable data. According to the insurance companies who are eager to have customers, they are not getting reliable data all the way through the system.
Even as another outage involving Verizon's Terramark unit hobbled healthcare.gov for much of the day today, Secretary Sebelius says she is confident that the website will be up and fully up to speed by November 30th, in time for people who want to enroll for coverage starting on January 1st. Bertha Coombs, Nightly Business Report, Washington.
Most American workers don't have to shop for a new insurance plan on those government exchanges because millions get coverage through their jobs. And with the annual open enrollment period fast approaching at companies big and small, many employees are now wondering how the Affordable Care Act will change things for them, and if that means big price increases for their health insurance premiums. Scott Cohn takes a closer look.
Larry Burns from outside Philadelphia just got the news from his employer. His health insurance premium for next year is going up.
Maybe 8%, 9%, something like that.
He's not alone. Across the country, employers are sending out annual enrollment materials with a bitter pill, higher premiums, in some cases double digits. And part of the blame? Federally mandated health care changes, health care reform, the Affordable Care Act.
It was just, here it is, pay it, you know?
It's not just higher premiums. Deductibles are rising as companies try to shift more of the risk and responsibility for healthcare costs to their workers. Rising premiums at work are nothing new. In fact, they've been going up for years. The Kaiser Family Foundation, which tracks these things, says over the past 10 years, your cost of coverage at work has gone up 89%. The study says employers have been passing on their added costs and then some, as insurers like Aetna pass on their costs. The company's CEO says the Affordable Care Act is compounding the problem.
Aetna alone will pass through to its customers over $1 billion worth of taxes and fees associated with the Affordable Care Act that need to go into pricing.
Divided among Aetna's 22 million members, that's not much. But employers, like hospital operator Universal Health Services, say there are other added costs. Children covered on their parents' plans till they're 26, and the protections for pre-existing conditions.
The analogy would be your house starts to burn. You call the insurance company immediately and say, I'd like household insurance. They say, okay, sure.
But even employers say much of the increases are simply the result of rising health care costs and more people using health care, factors that, at least for now, have nothing to do with Obamacare. Scott Cohn, Nightly Business Report.
And here to talk more about the changing landscape of health insurance is Greg Garthwaite. He's Assistant Professor of Management at Northwestern University's Kellogg School of Management, and he specializes in healthcare. Craig, welcome. Good to have you with us. I assume you heard Scott's package there. I'd like to get your best guess, your estimate of how much or what percentage of the premium increase I may get next year in my company plan is attributable to the Affordable Care Act. Is it 20%, 50%, 80%? What?
So I really don't have an exact number for that, but I think what we are seeing is that there's going to be a mixture of two things that are causing premiums to go up. One is that we're coming out of the recession, so health spending is going to start to increase again. We've had relatively low increases in health spending over the past 2 years as a result of the recession. And the second is that a lot of company plans have to be more generous to meet the minimum standards under the Affordable Care Act. And those are the two primary drivers of increased premiums in the workplace.
The other thing that a lot of people are asking questions is, whether you work for a company, a big company, a small company, or no company, that ultimately every American person is going to have to sign up for these healthcare exchanges. Is that a good thing? What are the pros and cons of that?
So I think certainly what we'll see is that a lot more people who are in employer coverage now are going to move into the exchanges, and that probably will be a good thing for them. But these are going to be people who are eligible for thousands of dollars in subsidies from the federal government, and now that they get their insurance not from their employer, they'll be free to move across employers, move from a large to a small employer. There'll be lots of benefits there. Aren't there also some
downsides to that too?
Yeah, well, the downside certainly at a minimum is going to be that the cost of this bill is going to end up being far greater than we ever estimated, and that's going to come out of every individual American taxpayer. And we're just not, I don't think we're adequately preparing for the increased cost of the ACA.
So is what you're saying, Professor, that more and more companies will get away from offering health insurance as a primary benefit to their employees, big companies and small companies?
Yeah, I mean, I think what we'll find is that if you have a lot of low-income employees, if you give them health benefits, then they're ineligible for all these subsidies that President Obama keeps talking about. You know, for a family of 4, you could be talking about a subsidy that's upwards of $13,000. And so it's going to be a change in the paradigm of the employer that a lot of what we used to think of as good employers, it might be better for them to not offer insurance to their employees and let them qualify for these federal subsidies.
Now, the whole premise of this Affordable Care Act is to get healthy young people to sign up for the program. The way things are going, do you see that happening? And if it doesn't, what does that mean for the whole financial, the financial health of this health care plan?
I mean, that's all going to hinge on the website. And that's really, from my view, the primary reason why Sebelius should have been apologizing today, because if we don't get that website working, we don't make it easy for people to sign up, then the people who least want health insurance, who are going to be the young, healthy people that Susie's talking about, those people are not going to sign up. And if we don't get them into the pools, then all we're going to do is have a series of exchanges that have relatively old and relatively sick people. And the economics of the Affordable Care Act just don't work without young, healthy people being in the insurance pool.
Your very quick opinion, is disconnecting health insurance from employment a good thing ultimately?
Yes.
All right, that was a quick answer there. Craig, thank you very much. Craig Garthwaite, Assistant Professor of Management at the Kellogg School at Northwestern.
And a little later in the broadcast, a story about how the changes and expenses in healthcare coverages are turning many financial advisors into healthcare advisors.
Well, disappointing news in today's ADP jobs report for October. The payroll processor reported that private companies added just 130,000 jobs this month, fewer than forecast, as the 16-day partial government shutdown and debt limit standoff appeared to slow an already weak labor market.
And that's one reason that the Federal Reserve decided today to continue its massive bond buying program to give the U.S. economy a boost. Wrapping up a 2-day meeting, policymakers at the central bank forecast weaker growth ahead and said the Fed will continue its stimulus program and keep its key interest rate at 0%. The Fed's statement signaled that the economy continues to improve, but only modestly.
Well, investors pored over the Fed's policy statement and seemingly didn't find much to hold on to. Stocks, of course, set a lot of records yesterday. Maybe they were just tired today, and that's why they sold off. It's probably as good an explanation as any. The Dow was down 61 points, the Nasdaq off 21, and the S&P was lower by 8. Prices on 10-year U.S. Treasury notes were lower today. Yields spiked higher to finish at 2.54% after the Federal Reserve wrapped up that 2-day meeting.
Joining us now to talk more about that Fed meeting and the markets, David Kelly. He's Chief Global Strategist at J.P. Morgan Funds. So, David, really no surprises on that Fed decision. Everybody was kind of expecting it. But there was speculation that one of the reasons that the markets stayed in the minus column was that there was speculation that maybe Ben Bernanke will begin this whole tapering thing before he steps down as Fed chief anytime between December and January. What do you think?
I think that's possible. I don't think anything in this statement would have said that. I think that the only piece of news in this statement is that they removed language which they put in the last time around, which said that they were worried about rising interest rates. If you recall back in September when they decided not to taper then, what they said is that they were worried that rising interest rates would actually slow the economy. They removed that language. Now, if you think about it, back then, the 10-year Treasury yield was about 2.7%. As of this morning, it was 2.48%. So what they're really saying is 2.7% we're a little worried, 2.48% we're fine. But if the Fed's fine at 2.48%, then why should people buy a bond at 2.48% expecting rates to go down any further? So I think that's really why rates moved up a little bit, and I think that probably hurt the stock market. But overall, there's not a lot of news in today's statement.
You know, 6 weeks ago, David, I can't remember a more eagerly anticipated Fed meeting. Today's Fed meeting had none of that drama. Are you expecting that there will begin a pulling back of the bond purchasing sometime over the next 6 months? And will it be by Ms. Yellen or Mr. Bernanke?
Well, yes. And the second answer is it's a close call. But I think the key trigger here is actually got to do with the other side of Washington. I'm confident that the economy will pick up enough. I'm confident the unemployment rate will come down enough to justify the Fed tapering. But the real issue is, will we have an extension of the debt ceiling? Will we deal with another potential government shutdown in January? If we can have the government fully financed through 2014 with no issue on the debt ceiling, then I think that removes the last impediment to the Fed beginning to taper. They do need, they've got a long, long way to go to get back to normal, and they really need to get going. And so if in January, in the middle of January, we do come up with an agreement in Washington to fund the government and to extend the debt ceiling, then I think it's possible that with Ben Bernanke's last meeting at the end of January, that's when we'll begin to taper.
And there's no question, trimming back the stimulus, this massive stimulus, is going to be tricky. I mean, it's fraught with a risk. So if it does fall in the lap of Janet Yellen for the most part, what are the key things that she has to do so that in no way do those actions disrupt the markets and the economy?
Well, the first thing, of course, is they need to get started. But I think they shouldn't overstate the value of QE in helping this economy, because this economy has not really been doing that well. I mean, it's still only growing about 2% since the start of this expansion. And removing all this QE won't really hurt the economy that much either. So I think the Federal Reserve needs to express confidence that the economy can grow without this stimulus, and then just, get going and allow us to get back to a clear path towards normal. If people felt the Federal Reserve was getting back to normal, they might get back to more normal decisions on businesses and investing, which would actually be a good thing.
The S&P 500 is up 24% this year. How much of that gain is directly attributable to what the Fed's been doing?
I don't think a lot of it is. We have seen in the last few months more money going into equity funds, presumably because people feel there's no opportunity in fixed income. But for most of this rally, money has been moving out of equity mutual funds even as the equity market goes up. And that suggests to me that it's not really QE that's been pushing the market up. It's just the market was too cheap. And so professional investors recognize some opportunity there. I still don't think the market's overvalued, but I think that if you keep the sea of liquidity growing here, eventually the market will become overvalued. And that's one other reason why the Fed needs to get going right now, to make sure that this thing doesn't get out of hand.
Okay, we're going to have to leave it there. David, thank you so much. David Kelly, Chief Global Strategist at JP Morgan Funds.
And still ahead, what's helping drive General Motors into its strongest financial position in years? That story is next.
Earnings out after the closing bell from Facebook, sending shares soaring after hours. The social networking giant beating Wall Street estimates last quarter on strong growth in mobile advertising, which now accounts for half of its overall revenue. Facebook earned 17 cents a share, excluding certain items, with total revenue topping $2 billion. Seema Modi joins us now from the NASDAQ exchange. So, Seema, you've had a chance to look over the numbers. What's the one takeaway you see in Facebook's third quarter numbers?
Sure, Susie. What's getting investors really excited is the fact that Facebook is making more money on mobile. Sales from mobile ads made up 49% of Facebook's total ad revenue this quarter. Facebook also saw a jump in mobile monthly active users. So it's driving more users to its Facebook platform via a smartphone. That's what the street has been wanting. Facebook strengthening its mobile growth strategy, and that's what they really got this quarter.
All right, Seema, thank you very much. Seema Modi reporting from NASDAQ for us. Meanwhile, before the opening bell this morning, General Motors said its profits fell more than 50%, but the quarterly number was still better than Wall Street estimated. The automaker reported strong sales of pickup trucks and said its European operations are improving but still posting heavy losses. Phil LeBeau has more.
From the assembly lines in Michigan to the showrooms in China, General Motors is revving up profits. Excluding special items, GM made 96 cents a share last quarter, 2 cents better than Wall Street was expecting.
Market share was up, revenue up, profits up, cash flow up, so a really strong quarter across the board.
GM's making most of its money, more than $2.2 billion, in North America, where U.S. sales are being driven in part by new versions of the Chevy Silverado and GMC Sierra pickup trucks. CEO Dan Ackerson says the launch of those trucks has been near textbook perfect. Those trucks have helped GM hold on to its lead as the #1 automaker in the U.S., ahead of Ford, Toyota, and Chrysler. Meanwhile, GM reported a 60% drop in earnings overseas. It cut losses in Europe, and sales in China remain strong. With GM holding $26 billion, investors are asking when the automaker will return some of that money to shareholders with a dividend.
Priority number one is reinvest in the business. Priority number 2 is to maintain and strengthen our fortress balance sheet, which we've been continuing to do, including activities through this quarter. And priority 3 is to generate returns of cash to our shareholders, and that's something that we'll continue to evaluate over time.
Today's earnings pushed GM shares close to their highest price since the company's IPO in 2009. With the U.S. Treasury scheduled to sell its remaining stake in General Motors over the next couple of months, GM is hoping the stigma of being bailed out by Uncle Sam will fade away. And with it, any doubts the new GM will repeat the same mistakes that led the old GM to file for bankruptcy. Phil LeBeau, Nightly Business Report, Chicago.
And to read more about General Motors earnings and its outlook, head to our website, nbr.com.
Visa shares drop after the bell, and that's where we begin tonight's market focus. The world's largest credit card company reported a decline in quarterly profit in its first report as a Dow component. Visa cited a tax reserve as the reason for the fall, overshadowing an increase in the number of payments processed. Shares fell a fraction in the regular session to $203.82, and in the extended, the decline continued after the close. More people around the world are visiting Starbucks stores, which help boost profits. The coffee giant saw a 34% rise in earnings, but revenue slightly lower than expected, and its profit forecast for next year was soft. Nonetheless, the CEO said he was proud of the results.
This quarter is his stunning quarter, which caps, as I said, the best performing financial and operating year in the history of the company. For us to have 8% comps in America with our store base and 7% globally at a time in the world where the consumer is still under pressure is such a significant accomplishment.
Shares fell after hours on that forecast, but finished the regular session higher to $80.83.
Shares of the fizzy drink machine maker SodaStream plunged after the company reported results that missed estimates. Profits fell slightly because of higher operating costs. Revenue also missed, but SodaStream kept its full-year outlook. The stock down more than 10%, though, $56.87 to close. Comcast, the nation's largest cable provider, reported earnings that beat estimates as the company generated more cash flow at its cable unit and media arm, NBC Universal. Revenue shy of estimates. Shares of the cable company, the parent of Nightly Business Report's producer, fell more than 1% to $47.09.
And coming up, you go to a financial advisor when it comes to your budget and investments, but would you go to one for healthcare questions? But first, here's a look at commodities, treasuries, and currencies. If you're confused by the new vocabulary of health insurance, you're not alone. So it's no wonder many people are turning to their financial advisors to help them figure out their health care options and costs. And others are thinking about getting a health care advisor, too. Sharon Epperson explains.
If it wasn't already difficult saving for retirement, uncertainty about the cost of health care has become a major concern. Would you turn to your financial advisor for guidance?
More than likely, I'd find someone in the like an insurance broker, someone that understands the insurance part of it. I don't rely on my financial advisor for health care.
I wouldn't even ask him. His job is to handle money that I have invested, not to take care of my health care.
They should be part of the process. I mean, it's a big part of your finances.
Now many financial advisors wear at least two hats, as those who may have focused primarily on investments are being tasked with helping clients navigate the changing healthcare landscape. The Affordable Care Act has resulted in many new developments in the delivery of healthcare, which is making retirement planning even more challenging, especially as many employers are changing or plan to change their coverage for retirees. A study this month by Towers Watson found that for those employers that sponsor a retiree health plan, about 40% plan to discontinue it in 2015.
I find that most people are more comfortable talking about their health care problems than they are about their financial issues, because health problems aren't under your control. So if a planner becomes comfortable just asking basic questions like, what medications are you on? Have you ever been in the hospital? Those are all things that clients, when they know what you're planning for, are happy to share with you.
Financial advisors say the key for consumers is to find a financial planner who takes a 360-degree view of healthcare choices and understands the risks and tax consequences.
You want that expertise or that knowledge of the actual healthcare options, but you need that peripheral vision of a certified financial planner to understand that, the tax impacts, the cash flow impacts, all the other ways in which your healthcare impacts your total financial picture.
Someone with a CFP, the CFP Board's Certified Financial Planner designation, is required to complete training in comprehensive financial planning, not only in making investment decisions. For Nightly Business Report, I'm Sharon Epperson.
And for more on where to look for a healthcare advisor, log on to our website, nbr.com.
And finally tonight, Forbes magazine is out with its annual ranking of the world's most powerful people. Here are the top 3. See if you can guess. In third place, Xi Jinping. He's the General Secretary of China's Communist Party. In a surprise move, Barack Obama drops to number 2 on the list this year from the top spot, and taking his place, Russian president, and apparently any other title he wants to hold, Vladimir Putin. And recapping Facebook's earnings for you, following an initial pop after hours, the stock has reversed direction. One thing the market may be focusing on, comments on a late-day conference call where the CFO said he saw a decrease in daily users, specifically among younger teens.
Look at that drop on the
Look
chart.
at that. It was a
Pretty amazing.
short-lived pop in Facebook stock.
That's Nightly Business Report for tonight. I'm Susie Garib. Thanks so much for watching.
And thanks from me as well. I'm Tyler Matson. Have a great evening, everybody. We'll see you back here tomorrow night.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garib with a Nightly Business Report news brief. President Obama on the defensive today, trying to drum up support for his troubled Affordable Care Act, admitting to problems with his healthcare.gov website and that people are getting cancellation notices. But he said giving people health care should be a no-brainer. The Federal Reserve decided to keep buying $85 billion in bonds every month and to keep key interest rates at record low levels. On Wall Street today, there were no record highs because of a weak report on private jobs. The Dow fell 61 points, the Nasdaq down 21, and the S&P lower by 8. And a jump in mobile advertising helped drive a 60% increase in revenue at Facebook last quarter. Be sure to tune in to Nightly Business Report right here on your public television station.